I'm thrilled to be here today to discuss an exciting yet controversial topic, stablecoins and their impact on monetary policy. Let's dive in. The rise of stablecoins, a game changer? Stablecoins, once considered an outcast, have emerged as a powerful force in the financial world. These digital currencies, designed to provide stability, have gained traction by offering a reliable store of value, a convenient means of payment, and the ability to move capital across borders effortlessly. Dollar demand and the Genius Act. The demand for dollars remains strong, and stablecoins have become a more efficient way to access this global currency. The recent Genius Act, guiding and establishing national innovation for U.S. Stablecoins Act, has paved the way for stablecoin issuers to expand their reach, solidifying their role in the payment system. This regulatory move is a significant step forward, but it also raises some intriguing questions for economists and policymakers alike. Stablecoins and the dollar's dominance. Nearly all stablecoins are denominated in dollars, and their success is deeply intertwined with the U.S. dollar's status as the world's preferred currency. Stablecoins are further enhancing the dollar's dominance by providing a platform for people worldwide to access and transact in the most trusted currency. My key argument is that stablecoins are already increasing the demand for U.S. Treasury bills and other liquid dollar-denominated assets outside the United States, and this trend is set to continue. This new demand benefits the U.S. government by lowering borrowing costs. However, as a central banker, I'm particularly interested in how stablecoins might influence a critical guideline for monetary policymakers, known as the neutral rate, or asterisk. The neutral rate and stablecoin impact. The neutral rate, or asterisk, is the policy interest rate that maintains economic stability when the economy is operating at its full potential. Stablecoins could significantly impact this rate, and there are open questions about their long-term effects on U.S. monetary policy. For instance, how much capital will stablecoin issuers manage, and where will these funds come from? Will they be domestic or foreign, and could they potentially draw funds away from the traditional banking system? What are the systemic risks associated with a potential run on stablecoins? Genius Act, a regulatory breakthrough. While I typically approach new regulations with caution, the Genius Act is a welcome development. It establishes a regulatory framework for stablecoins, ensuring legitimacy and accountability akin to traditional dollar assets. For monetary policy, the crucial aspect is that it requires U.S.-based issuers to maintain reserves backed by safe and liquid U.S. dollar-denominated assets on a one-to-one basis. These reserves can be held in various forms, such as bank deposits, short-term treasuries, or government money market funds. Even stablecoins outside the scope of the Genius Act are likely to boost demand for U.S. treasuries and other dollar-denominated assets. While these non-compliant stablecoins can invest in a broader range of assets, they will likely still heavily invest in low-risk U.S. dollar securities to maintain their reliability as a store of value. Projected growth and potential impact. Federal Reserve staff estimates suggest that stablecoin uptake could reach between $1 trillion and $3 trillion by the end of the decade. To put this into perspective, during the latest round of quantitative easing in response to the COVID-19 pandemic, the Fed increased its holdings of U.S. Treasury securities by just over $3 trillion. If these forecasts prove accurate, the additional demand from stablecoins will be a force to reckon with. The potential for widespread adoption. The innovation of public blockchains allows stablecoins to trade freely on a global scale. This advancement offers a transformative opportunity for consumers and businesses outside the U.S., especially those in emerging market economies or advanced foreign economies with restrictive payment systems. Stablecoins provide a bridge for these individuals and businesses to access dollar-denominated assets, which are often limited or inaccessible due to capital controls and other restrictions. For those who want to use dollars as a store of value or a means of payment but face barriers, stablecoins offer an incremental solution. While they won't instantly remove all obstacles, stablecoins will create pathways and make it easier to access and use dollars. Implications for monetary policy. The balance between the supply and demand for loanable funds determines the neutral interest rate, R**. Recent research, such as the work by Marina Azzamonti and Vincenzo Quadrini in 2024, suggests that widespread adoption of stablecoins could put downward pressure on interest rates, potentially by as much as 40 basis points. If stablecoin issuance grows as projected, it will significantly impact the demand for U.S. Treasuries and other highly liquid dollar assets. This scenario is reminiscent of the global saving glut era, which former Fed Chairman Ben Bernanke identified as a major factor in declining interest rates around the turn of the millennium. A potential increase of $2 trillion in foreign demand for dollar assets by the end of the decade could widen the U.S. current account deficit by approximately 1.2 percentage points of GDP over this period. This increase would be a substantial portion of the original global saving glut. Conclusion: a multi-trillion-dollar challenge? The projected growth of stablecoins implies a significant increase in the net supply of loanable funds in the economy, which could push down the neutral interest rate, R. If R decreases, policy rates should also be lower to support a healthy economy. Failure to adjust policy rates accordingly would be contractionary. Additionally, a global stablecoin glut could replicate some of the consequences of the global saving glut, such as an increased likelihood of the zero lower bound, ZLB, binding in the future. This could limit the ability of short-term interest rates to provide accommodation while allowing them to move up to restrict activity. Furthermore, a stablecoin glut driven by flows out of foreign currencies into the US dollar could strengthen the dollar, potentially impacting the Fed's price stability and maximum employment mandates. Finally, increased dollarization could reduce the benefits of floating exchange rates, intensifying the volatility of global business cycles and increasing business cycle synchronization. America's capital markets are the deepest in the world, supporting economic growth and efficient capital allocation. However, our financial infrastructure could benefit from an upgrade, and stablecoins may lead the way in facilitating dollar holdings and payments both domestically and internationally. As we navigate this rapidly evolving landscape, it's crucial to consider the potential implications of widespread stablecoin adoption for monetary policy, both in the U.S. and globally. The scope for rapid increases in stablecoin issuance makes this an imperative topic for further exploration and discussion. I welcome your thoughts and insights on this complex and fascinating subject. Let's continue the conversation and explore the potential future of stablecoins and their impact on our financial systems.